That was chapter 1 and chapter 2. Any questions? Yes?
What is the second for the three tests? What you said?
Sorry?
Like the second one for the three tests of,
So the first is there a tax benefit? Second is it a tax avoidance transaction? And the third is misuse or abuse.
thank you.
Chapter 3. Page 27. Who pays tax? The answer is residents. People who are resident in Canada. Notice I didn't say citizens. Are there any Americans here? Americans who live in Canada have to pay U.S. taxes because they are citizens of the United States. The United States is one of maybe 5 countries in the world that tax people because they're citizens. You can go live anywhere in the world, but you still pay American taxes. In Canada, we tax residents. Residence is mostly where you live, but as we're going to talk about, there's some other factors that come into it. So we, in Canada, tax residents. We tax residents on their worldwide income. I happen to have some investments in U.S. companies. As a Canadian resident, I have to pay tax on all of my income wherever it comes from, including U.S. source income. Actually, that makes sense to me. I mean, I'm a resident of Canada. I get that I should pay tax on my Canadian source income. And really, I should probably pay tax on my U.S. source income as well, because I live here. I benefit from infrastructure and healthcare and so on. Even if all of my income were foreign source income, I get that I should be taxable on it in Canada. I don't want to pay tax to both countries, and there are mechanisms to avoid that we'll talk about later, but in the meantime, I'm okay as a resident that I should have to pay tax on my worldwide income here. Page 27, the paragraph that says the courts have concluded. You can't find in the Income Tax Act a definition of what it means to be a resident for an individual. It just doesn't exist. So whenever we have uncertainty and we need an answer, somebody goes to court. So there's a whole whack of court cases that say whether an individual is resident depends on a bunch of factors, like, for example, where they live. What are their employment ties? What are their family ties? Do they have a Canadian driver's license? Do they vote in Canada? Do they have club memberships here? Does their sort of circle of relationships and memberships and stuff like that indicate that they have a closer tie to Canada than they do to the United States or Mexico or wherever else they spend time? I mean, a person could spend a lot of time outside Canada but still be considered resident in Canada if these factors indicate that their closer ties are to this country. Maintains formal social ties with clubs and other associations, holds Canadian investments. I'm a Canadian CPA. Visits Canada for short periods regularly, maybe has children here, whatever. So we call that a facts-based determination. What are the facts? CRA's actually got a couple of questionnaires on this that are very helpful for people who are coming or going to say, you know, list your ties in this country or that country, and let's compare and see where you've got the closer ties. And there might even be cases where the Canadian ties are not closer than the other country ties, but are still sufficient to make it look like you've got enough connection to Canada that you're subject to tax here. On top of that, if my ties were closer to, say, the United States, but I happen to spend more than 182 days here, I'm considered to be a Canadian resident. I am deemed to be a Canadian resident for the entire calendar year. Again, all my ties might be in the States, but for some reason in the calendar year I spend more than 182 days here, I'm deemed to be a Canadian resident regardless how tenuous my ties are to Canada, called the sojourner's rule. A sojourner is someone who, I guess, travels to various places at various times during the year. So if I sojourn to Canada and I spend more than 182 days here, I'm Canadian resident for that calendar year. Now those 182 days might all be at the beginning of the year, something like that. I'm a resident for the entire year. Now, if I have immigrated to Canada, so I establish close ties here. Let's say I establish those ties on September 30th. I'm a Canadian resident from September 30th to December 31st. So that's not for the whole year. If I leave Canada, and I leave Canada on April 19th, I'm only a Canadian resident up until April 19th. Then I cease my residency because I made all of these things go away. So if I'm not a sojourner, I'm only a resident during the period when I'm a resident. It's only if I'm a sojourner that I'm deemed to be a resident for the entire year. And as I said, the importance of being a resident is I have to pay Canadian tax on my worldwide income. Corporations. Thinking, oh, corporations, this must really be difficult. No, it's actually, a corporation is considered to be resident in Canada if it's incorporated under Canadian law. Period, end of story. That could be federal law or provincial law, whatever. Corporation that's incorporated under Canadian law is considered to be resident in Canada and thus pays tax on its worldwide income. Diane. Page 28, non-residents. Non-residents have to pay some tax here on certain types of income if they earn it here. A very good example is entertainers. Entertainers who come to work here, for example, for a run at MTC or to play at my beloved folk festival. I love the folk festival. That's taxable income here in Canada, so they have to pay tax on that. So just for that period of time that they're actually earning income here in Canada. If you go to top of page 29, they pay so-called tax on net income. So just like I would pay, I figure out what my net income is and pay tax on it at whatever tax rates, individual tax rates. On business income in Canada, sell types of Canadian property. You can put land beside that one. Or if they're employed in Canada, like for example the entertainer example that I used. So they file a Canadian tax return, but the only income that goes on it is just what they earn in Canada. So it's pretty straightforward. Number 2, tax on Canadian source income. This is different. This is like investment income. So for example, if a U.S. person has a bank account in Canada and earns interest. So investment income, we would also call that passive income. The types of income higher up on the page are active. I would call that business income and employment income. But now we're talking about passive income like earning interest or dividends or that type of thing. They don't have to file a tax return. Good for them. But Canada withholds some tax on the income that gets paid to them. So for example, if an American earns $100 of interest, Canada will withhold, I forget what it is, each country is different because Canada has an agreement with every country. It's usually 25%, so Canada would withhold $25, and the bank would just pay $75. But Canada's got a treaty with the United States, so it's probably $10. You don't need to know that. All you need to know is the principle that for passive types of income like investment income, interest, dividends, some other examples here, probably royalties. Canada withholds, that is, the bank is required to take away, in my example, 25 cents, $25, and send that to CRA, and then just pay the net $75 to the American person. The American person probably, when they fill out their U.S. tax return, and they have to report that $100 as income, but they'll probably get a deduction or a credit or something for the $25 that got paid to Canada. So you don't have to worry about them. Just worry about the fact that non-residents have tax withheld on them on passive types of income, such as the ones listed on the bottom of the page. We will finish today to talk about taxation year. So once you figure out who's going to pay tax, you have to say, well, okay, well, for what period of time? Individuals, it's the calendar year. So we all file calendar year tax returns from January 1 to December 31st. Unless I ceased residency or became a resident, then I would have maybe a 3-month or a 6-month or something like that return, say from January 1st till April 19th or from September 30th to December 31st. But generally speaking, it's the calendar year for individuals. Corporations, very simple, it's their fiscal year. So corporations can choose whatever year they want. If a corporation started today, it's January 4th. If they want to, they could have a December 31st year end. If they want to, they could have a January 5th year end. If they want to, they could actually cut off as of close of business tomorrow and file a 2-day tax return. Or if they want, they can extend it all the way till December 31st. Or actually, they can even extend it into 2018, just as long as the first taxation year is not more than 53 weeks. Most companies choose a December year end, unless maybe there's some business reason why a different year end is good. For example, farming companies often choose a July year end because it's the end of the crop year, or they choose a year end when inventory levels are low, therefore it's a lot easier to count the inventory. These are real reasons why companies choose this or that fiscal year end. And whatever their fiscal year end is also their taxation year end. That's a very good place to break. I will, this weekend, send you a little video about what this corporate tax thing is all about. I hope you find it interesting. It's in the papers daily still, and a really big part of the tax scene right now. Thank you and have a good weekend.